Have you ever pondered about the value of investing in an S&P 500 index mutual fund? If so, you're certainly not alone. This question sits on the minds of many aspiring to amplify their wealth. Before we dive deep into this, let's decode what an S&P 500 index fund is. Visualize a basket. This basket, however, doesn't contain fruits like apples or oranges. Instead, it's brimming with stocks, and not just any stocks, but those belonging to the 500 largest companies listed on the U.S. stock exchanges. This is what we refer to as an S&P 500 index fund. It's an investment tool that provides a piece of these premier companies in one compact package. A primary advantage of this fund is the principle of diversification. By scattering investments over a wide range of companies, it mitigates the risk associated with placing all your eggs in one basket, or in this context, channeling all your money into a single company. Nearly all major brokerages and fund companies now offer some type of S&P 500 fund. Investors may access these funds through financial advisors, full-service brokers, or discount brokerages. Now let's dive into its performance over the last 2 decades. The S&P 500 has a reputation for delivering solid returns over the long term. But how has it performed in the past 20 years? Let's take a stroll down memory lane back to the year 2004. The S&P 500 was steadily rising, showing promising returns for investors. Then came the financial crisis of 2008, a difficult period for the global economy. Despite the turmoil, the S&P 500 bounced back remarkably well, underlining its resilience and long-term potential for growth. Moving forward to 2009, the fund embarked on a bull run that lasted a whole decade, outperforming many actively managed funds. This period was marked by significant events such as the European debt crisis and the US-China trade war. But the S&P 500 proved its mettle by weathering these storms. By 2019, the S&P 500 had more than quadrupled from its low point in March 2009. This impressive performance was driven by the strong growth of U.S. companies and the overall health of the American economy. The year 2020 brought about the global pandemic, a sudden and severe challenge that saw huge drops in the fund's value. Yet, as we've seen before, the S&P 500 bounced back in a big way. By the end of the year, the fund had not only recovered its losses, but also reached new heights, a testament to its resilience. As we venture into the present, the S&P 500 continues to be a reliable choice for investors. Despite the ups and downs, it has consistently outperformed most actively managed funds over the past 2 decades. This performance isn't just about the numbers, but also the fund's ability to weather economic storms and come out stronger. As we can see, the S&P 500 has consistently provided substantial returns over the past 2 decades. In fact, it has provided average returns of over 7% adjusted for inflation, making it a potentially very reliable choice for steady, long-term growth. One of the key advantages of any S&P 500 fund is its low costs. These funds typically have low expense ratios. Now, what's an expense ratio? It's the annual fee that all funds or ETFs charge their shareholders. It's represented as a percentage of the fund's total assets. The lower the expense ratio, the less you pay in fees, which means more of your money stays invested and has the potential to grow. S&P 500 funds, on average, have an expense ratio significantly lower than many other types of funds. This cost-effectiveness can enhance your returns over the long term, especially as these savings compound year after year. This is particularly advantageous for beginner investors who may not have a lot of money to invest initially. Every penny saved is a penny earned, as they say. In summary, S&P 500 funds can be a good investment option due to their diversified portfolios, consistent returns, and low costs. They represent an excellent way for new investors to achieve good potential returns without having to spend time researching individual stocks. If you found this video useful, please don't forget to like and subscribe to the channel.